How are you doing, guys? It's Damien here. In this video I will address the question of why I avoid index funds. You can use SIPP or 401k account instead. Last week I showed you that I bought the Uber stock for my Revolut portfolio. Today I will show you my recent transaction of buying Uber stock to my pension portfolio. Smash that like button for the YouTube algorithm. It will help reach more people and will encourage me to give you more useful content. First, quickly, what is a personal pension? Personal pensions are pensions that you arrange yourself. They're sometimes known as defined contribution pensions. You'll get a pension that's based on how much was paid in. Also, it is based on the return from investments. You can opt for a traditional personal pension or a self-invested personal pension. In the traditional pension option, a default option is to invest money into index funds, which follow the market. But this option does not allow for self-investment. In the second option, you can invest in individual stocks inside the pension account. Such an option is given to us by SIPP, which stands for a self-invested personal pension in the United Kingdom, or 401k in the United States. They let you invest directly into listed shares. SIPPs are tax wrappers, allowing tax rebates on contributions in exchange for limits on accessibility. It enables people to build portfolios that are tailored to their specific needs and risk appetite. Because I live and work in the United Kingdom, I use SIPP as one of my investment accounts. Such a pension is for someone who wants to take control over their money and enjoy greater freedom over where it is put to work. I have added a link to the government website with information about personal pension so you can get more information and decide if to use it. Let me explain how I use my pension account for investing. The company I work for has a generous scheme. In short, I contribute 7% of my salary and my employer tops it up with an extra 16%. In the previous company I worked for, it was 4% and an additional 6% respectively. My retirement savings contribution is topped up by the company I work for. These savings are deducted from my paycheck before taxation, so taxes on this money are deferred until withdrawal in retirement years. All this money goes to a default pension managing company, which invests in index funds or very diversified mutual funds, which, through its broad diversification, cannot beat the market. What I do is that every few months I move the pot from the default personal pension to my SIPP, and I choose shares of companies which, according to my research, will give me the best return in the long term. Okay, so after this introduction, let me explain the reasons I prefer to buy individual stocks. An index fund buys all the components of a market index. For example, the S&P 500 index in proportion to the weighings of the index. It means that it gives exposure to all of the companies included in the S&P 500 index. These companies are automatically bought through the computer algorithm. The index fund returns are matching the behavior of the market. There is no underperformance, but there is no beating the market too. Okay, the first reason for avoiding index funds. The returns you can achieve in the long term from index fund investing are correlated to the growth of the economy. For the S&P 500 index, we need to look at the United States economy. Currently, the earnings yield for the S&P 500 is 4.3%. That is what we can expect in the long term from investing in the S&P 500 index. In terms of individual companies, stock prices are correlated to the performance of underlying businesses. Knowing this, I can focus on choosing the businesses with much higher earnings yield. For example, Apple company earnings yield is around 8 to 10% in comparison to the US economy, which is about 4% at this stage of the economic cycle, as we saw from the earnings yield chart. The second reason is that I am beating the market. I aim at 15 to 20% return annually, and that is what I achieve on average. Let's look at the results for the current year in my SIPP portfolio. According to IGBL Invest, my portfolio year-to-date return is plus 35.84% versus 20.43% for the benchmark. IGBL platform chooses a benchmark which is the closest to the type of assets I have in my portfolio. Also, I had a chat with a colleague of mine about my results from investing in my SIPP account. He told me what his index fund returned, and that is what I would have if I did not move money to SIPP. He was quite happy with 16%, but I told him that for me the return is 36% in my SIPP portfolio and around 30% for my overall stock market portfolio. He said that it is still 16%, so it is not too bad. Okay, let's do the simulation of what difference it makes if you invest £200 monthly over 30 years with 10%, 12% and 15% annually. For a 10% annual return, it will accumulate to £455,000. Only 2% more annually on average will give 55% more money, which is £706,000. Then 5% more will accumulate to the amount 3 times bigger than what you could get with 10% annual return. That is why we need to care about the difference of only 2 or 5%, not to mention 20% difference which I achieved this year so far. And for me, it is obvious that I will invest myself, as I can achieve a much higher return than the market offers. That accumulates over time. The magic of compound interest is on my side. An index fund can be a mixture of 500 businesses. Do I consider all of these businesses great buys now? Of course no. There are businesses which are already matured and their growth is only around 3-4% annually. Let's think about horse racing as analogy. Would you bet $1 on each horse in a race, or would you instead decide to put the money on a few selected horses that look healthy, which showed good performance in the past and have some advantage over the other horses? So a company is like a horse, and a manager of a company is a jockey. In this example, if jockey drinks too much and does not sleep well before the race, he and his horse will not perform well during a race. In the company example, management, decisions, and behavior are affecting the performance of a whole company. He and his horse will not perform well during a race. In the example of a company, management decisions and behavior are affecting the performance of a whole company. There is the same analogy with investing in the stock market. You would not like to invest money in the shares of a company where there are some management issues, the product is getting obsolete, and the company does not have pricing power. It is about the choice of having the money in the best companies, carefully selected, versus all companies from a respective stock market. I think it seems reasonable. Buying index funds is like having a bet on all horses, both active and healthy, but at the same time sick or with a drunk jockey riding on it. An index fund buys every IPO. If it is big enough to be included in the index, it follows. For example, Uber was included in the Russell 1000 index at the beginning of July. I bought Uber to my portfolio at much more attractive level, when I consider the price of the business to be justified for buying. Also, I buy the best businesses instead of all businesses from the respective stock market. Uber is changing the transportation industry. It has the advantage of mixing ride-sharing and food delivery. When people think about ride-sharing, they automatically think about Uber. Having one app on the phone for all of these things is appealing to customers. We are already overwhelmed by the information, apps, and news, so having only one app for transportation services is an advantage. A self-invested personal pension is not for you if you want to invest small amounts of money on a low-cost basis without any financial responsibility. But as the example with compound interest showed, it is worth to learn to invest for beating the market. It will pay off and can mean earlier retirement than you planned initially. With investment in Uber stock, I invest in a new way of transportation. It is the biggest disruptor of the transportation industry apart from Tesla. I do not plan to trade these shares. I want to keep them long-term in my pension account. If you enjoyed this video, make sure to subscribe or feel free to add me on Instagram, Stocks and Freedom. Thank you so much for watching, and until next time, happy investing!